Before we begin with the show, I just want to take a minute out to shout out our friends over at Bitwise. Bitwise has a lot to offer people like us who live and breathe crypto. They are a crypto asset manager with more than $10 billion in client assets. They offer more than 30 products, and they've been building some of the most successful solutions in crypto since 2017. But here's what really stands out for me. Bitwise actually gets the crypto community. They donate a percentage of their profits from Bitcoin and Ethereum funds to the developers who help keep those networks running. What's their philosophy? If the ecosystem wins, everyone should win, and that includes the builders. You can't help but respect that. So go check out Bitwise, go to bitwiseinvestments.com and see all they've got to offer. That's bitwiseinvestments.com. There are tons of ways to invest in crypto. Do it with the people who care. Look for Bitwise.
Welcome back to everyone to Pro Crypto. I'm Jamie Coutts, and today we're joined by Alice Liu, research head at CoinMarketCap. Now, CoinMarketCap is, of course, one of the OG data platforms, still the most widely used window into what's really happening across the entire crypto ecosystem. So Alice's perspectives here from this very rich data perspective is going to be especially important, given today is October the 13th, and it's only been a couple of days since that tumultuous liquidation event that we saw on Friday. Markets obviously were rocked by this. We saw liquidations in magnitude that we've never seen before, tens of billions wiped out in open interest in just really minutes. So today we're going to unpack what happened last week, what are the lessons that we can take from it, and what the opportunities might be lying into Q4 and into 2026. Now, CoinMarketCap, because it is a fantastic analytics platform, have got a lot of products and features that we're going to try and also surface in that discussion as well. For me, which is I'm especially interested in because I use CoinMarketCap, but I really wasn't quite aware of all the breadth of tools that are there. So we'll be covering all that. And with that, I'll welcome Alice to the show. How are you, Alice?
Hi, Jimmy. Thank you for having me. Great to be here. I'm doing okay. I think given where the market is, it's been a crazy past few days for us. But overall, I think, yeah, I'm doing great with all this opportunities in the horizon for us.
Yeah, so you're staying sane, hopefully. Look, we're going to dive into all of that stuff, but I think it's really important that everyone gets a understanding of what your journey is, your sort of arc, your journey arc into crypto. So why don't you give us a bit of background about yourself before we dive into all the craziness that's been happening?
Yeah, sure. So I'm head of research at CoinMarketCap. I've been in crypto since 2021. I started from TradFi market. I was doing asset management in London for a private bank called Coutts, doing ETF selections, fund selections. So got my CFA, and then moved into crypto via ETFs. I was doing crypto ETFs for Wisdom Tree. And then, yeah, being for almost 3.5, almost 4 years with CMC, and every day and seeing all the crazy market movements. We've gone through DeFi summer together, gone through, the entire bear market and coming back onto the bull market again. Everyone is expecting, the market to have a great run for us this year, Q4 2025. And just look at what happened over the weekend. So yeah, it's been a very crazy journey for me since I joined crypto.
Oh, interesting. So we've got an ex-Coutts employee being interviewed by Coutts himself. Unfortunately, that's just my namesake bank. I have no ties to that, unfortunately. All right. So look, I mean, let's start with the obvious. Last week's flash crash, similar to what we saw in equities in 2010, took everyone by surprise. The largest liquidation event that we've ever seen, larger than FTX and larger than COVID, and Bitcoin obviously dropped about 15% in just minutes. But really, what happened in the altcoin space is where most of the action took place. It was obviously this major event or stress test of the whole crypto ecosystem's plumbing. You had leverage, you had liquidity depth, you had oracles not firing, or perhaps oracles misaligned. And there was, I guess, a lot of pressure on both the centralized exchanges and the decentralized applications within the ecosystem. So, with all that being said, from your vantage point at CoinMarketCap, what stood out to you most during that October 10th liquidation cascade?
Yeah, sure. Let's look at the damage first. Right now, as we speak, the total market cap has rebounded back a little bit. So we're just at 3.93 trillion USD. BTC is back up at 115K. A few other alts have also recovered, and CMC Crypto Fair and Great Index has finally bounced back from low 30s to 40. We're back into the neutral zone now. And alt season has been really damaged. So we're now 1 out of 100, we're at 45 for alt season. But let's look at what really happened over the weekend, right? You're right about the liquidation. In total, around 19 billion USD were liquidated within the 24 hours. You see the drop, the giant red bar we saw there. Um, Around over the weekend, right? This is about 4 to 5 times the magnitude of FTX crash itself, because around that time the market was relatively smaller. We only had 3 to 4 billion or so liquidated within 24 hours. So a few things that really stood up to me the most. Number one is during this period we've seen the flash of leverage. So all crypto assets were hit very heavily. BTC plunged to 102K, and that's like a nearly 16% drop. We also had Ether fell down to 3.6 K and down more than 20%. So the long tail altcoins were even more brutally hurt. So by saying that massive liquidation, some of the trigger impacts that we have nowadays at this 10-11 event compared with back then during FTX crash is that all this massive leverage tools that we now provide to users via DeFi, but also the links of that back to centralized exchange as well. So some of those mechanisms that we didn't have back then, we have now. And the more powerful the tools are, the worse the trouble is when it goes wrong. So overall, when we are looking back now, it's been close to 48 hours when it happened. We're now just looking through the aftermath and saying what are the lessons we learned. There's a lot of details we can go and unpack there, but yeah. So from the headline, this is the impact we had. Good news is we're bouncing back slightly, and we're seeing the Trump as the tackle trade that everyone is talking about. If the market slide still gives us a optimistic recovery, aka the ETF inflows is very important for today and tomorrow. If we still see that drive from traditional finance markets to go still into BTC and buy the dip, we are good. We're still set for a bullish Q4 for us.
Right. So you touched upon the ETF flows. I also agree there because they have been probably the best indicator. And you could see that actually they have pretty much top ticked and bottom ticked all the major turning points over the last 12 months, those ETF flows. Better indicator than really the Bitcoin treasury companies are sort of more structural buyers, but the ETFs, because of that sentiment factor, is very, very important. And that had started to turn up like a couple of weeks ago. So we were looking fine going into the event. Before we get to the sort of lessons, was there anything that you were detecting or seeing, or anything that the CoinMarketCap website was flashing that could have been read as a warning signal as we sort of learn from what happened? Was there anything there that you were noting in the sort of lead up to last week?
Yep. So in terms of predicting, there are a few things you can trace and track on chain, and you can go on to CoinMarketCap and you'll see some of the market cycle signals there. But I'll tell you what I did. I remember it was a Friday evening for me. I just had my Chinese hot pot with a group of crypto friends, and I got back. I was lying on sofa. I'd be like, "Oh, I was having food coma," and then I started to have notification pushes from my phone, and it's the price alert. And I was looking at like what's going on. So the first thing I did was I went on to CoinMarketCap, and you nowadays under any token price chart, you will have a list of AI populated questions. So for example, if we just click on Bitcoin, and you can see under the price chart, you will have CMC AI generated the question. Number one, if you click on why is Bitcoin price up today, um, the analysis there is driven by CMC AI tools. So that takes into consideration the live on-chain data, trading activities, volume, open interest, funding rates, liquidity, as well as the news RSS feed and the community sentiment. So we monitor every comments on CMC in the community section. That AI generates analysis of what is going on, the TA analysis, what's the most recent price range, etc. So some of those are very powerful tools that I've been monitoring for the past 48 hours just to help me identify where are the opportunities and what the risks are. So that's just an introduction of the a useful tool there. But apart from that, to answer your question more directly, what are some of those signals? I think it's hard for everyone to spot beforehand, but we definitely traced some aftermath in terms of the on-chain wallet movement, some of the presumed like inside trading, as well as some of the pricing mechanism risks that we identified along the way.
Yeah, I mean, one of the things that I was noting last week, but really didn't act upon, which in hindsight was obviously a mistake, was just the difference in the open interest on altcoins versus Bitcoin, and how much the altcoin open interest had grown relative to Bitcoin. Do you guys cover that open interest data set on the website?
For the open interest for the altcoins, we didn't aggregate them. But
Okay.
in terms of the open interest for altcoins vs that of Bitcoin, would you say that when altcoin season comes as well, or not really? It,
Yeah, the thing that I've been toying with, it's not so much that it's increasing, it's just the rate of change that tends to be important. And what I was looking at, now in hindsight, is just how much, like, if you do like a normalized z-score of the difference, that how extreme it was over the last couple of months. And so for me going forward, that's just going to be something that I pay a lot more attention to. I definitely track it for Bitcoin. Like, I always am interested to know when open interest is extreme relative to its past. But just that ability to also see in the altcoin market where that's happening as well is going to be obviously very important. It probably won't even be a problem now for a while because of the flush, meaning that it's going to take a long time for investors to start taking on extra risk. And I think we'll talk about these lessons now. I'd love to get your insights here. The lessons of leverage, the lessons of taking too much risk in this market, I think were laid bare once again. What do you think are the major takeaways for? Let's start with the ecosystem and the players, and then move to investors. I'm curious to know, like, in terms of just the way the market structure is currently, or how it behaved, the interaction between oracles, centralized exchanges, DeFi lending protocols. What's your thoughts about how it performed, and I guess where those lessons and improvements lie?
Sure. So you're right, because the microshock that was the initial spark. But what really tanked the whole market was the core structural issue, the flash of the leverage there. So what we are saying right now is the chain transmission risks within centralized exchanges. That seems to be one of the pain points. During previous bull markets, the explosive growth of, for example, the USDE was really driven and adopted by a lot of the major centralized exchanges as collateral for derivatives margin trading. This has created massive liquidity inflows and new use cases. But under the cross margin mechanism, all available funds and collaterals in a trader's accounts will jointly be used to maintain open positions and reducing the risks for early liquidation of a single position. However, during extreme volatility that we saw, losses on open positions can quickly consume the entire margin balance. So that triggers the centralized exchanges to automatically liquidate, to force sell all collateral assets simultaneously. And that's the downward spiral we're seeing, and hence the giant liquidation bars that we are seeing on the screen right now. So given the scale of these liquidations really far exceeded the market's real-time sort of ability, appetite to absorb it, USDE trading price on Binance sharply depacked what we saw on Friday. that plunged to close to $0.65 when it was supposed to be at 1. So a few things here, right? Number one is Oracle mispricing and the localized DPEG. What we mean by that is Athena Labs founder, he explained on X that the Oracle system really tried to differentiate between two scenarios. Number one is a temporary secondary market dislocation and a permanent collateral impairment. So the second part, which is the permanent collateral impact, that has never occurred for USDE before. And the DPEG that we saw was largely confined to Binance spot market. The DPEG likely stemmed from the interaction between Binance USD yield product and its internal pricing fate there. According to what Binance was showing, the USDE savings products really offered up to 12% APY, and that was supposed to continue to October 21st, but has now been suspended. What we saw, the loop of leverage and the internal pricing issue we're having here. In pursuit of this high yield, right? We have professional traders, market makers, normal users, and even institutions that may have used loan products or other services to really engage in high leverage recursive borrowing strategies, aka they would deposit borrowed USDE back into a saving product to compound returns. However, because of the Binance priced USDE based on internal market quotes and not on global weighted average, that's when USDE depegs, some of the users employing this recursive leverage strategy, they instantly face the margin breakage. So all this, over leveraged users, they were liquidated and the depeg was deepened for us. Hence, the trigger on the domino effects of that flash that we saw over the weekend. This is the part that we are now start to realize and learn from what the aftermath of this event. But what we are seeing is the link of DeFi application uses and link that with centralized exchanges. And when you have this type of recursive leverage strategies, as well as the Oracle pricing issues that have set the scenario, the stage for a flash liquidation to happen like this.
Yeah, that's a fantastic run through. But all I'm really hearing is overly complex system that was, I guess, just it was bound to happen at some point. I think obviously the impact of Binance's depegging as a major price feed into the oracles really sort of set the fire across the rest of the market. I've seen a lot of different takes on Twitter defending Athena's performance during this whole thing, while in the complete opposite. I wonder with the market structure bill that is being debated in the US at the moment, whether any of these existing structural flaws and the fragilities in the crypto in the decentralized finance market are going to be addressed through those regulations. And I don't know if you've got any thoughts on what's being debated at the moment, but do you see a lot of this being addressed in regulations or in legislation?
I have a very controversial opinion because like this, both you and I and many of Real Vision's audiences, they have TradFi background. And some of these derivative strategies or these leverage strategies, they exist in TradFi, but in the very deep end of TradFi, open to professional investors only. And the fact that the market, the whole market mechanism, how it sets, the trading hours, etc., means it wouldn't have the trigger on effects like what we would have in DeFi. So what we've seen is for the past 3-4 years or so, what has evolved in DeFi basically has caught up with what TradFi had been going for the past decades. So what TradFi has achieved in the past decades, DeFi has learned that very quickly, deployed in different innovative strategies, and got on with the tool very fast. So that's what has been happening for the past few years and leading up to the very sophisticated, advanced DeFi tools that we have nowadays. Now, coming back to the regulation side, I actually think what happened on October 11th would help DeFi more than hurt DeFi. What I mean by that is you start to realize DeFi is a great tool for traditional investors to go into a new market and participating in this market. It's great for institutions to hide behind synonymous address and then some of the strategy that deployed, aka some of the assumed inside tradings that we saw. Those were only, I guess, those were the synonymous address character it has in DeFi played a role in that. And also for normal users, I know it's hard for us to say because yes, we've all thinking it's better to not have over leverage, but at the same time, you understand why some people would put 100x or 500x leverage on certain things because they only have a very small capital to deploy there. So I do say DeFi and DeFi tools fill in a market gap here in terms of user needs. But for what we have learned from this is making sure the mechanism keep on getting refined, aka how the user were able to, like the whole liquidation process, for example, the pricing mechanism and rebuilding the trust, those needs to change. But at the same time, DeFi does serve as a great tool to fill in certain user appetites and market needs that we have here. So to me, yes, markets, they must demand, like they demand greater transparency and resilience, right? Some of those things are good characters that comes with DeFi. But at the same time, the fragile interdependencies we have between centralized exchanges and DeFi, that needs to be kept on refined and better boundaries to be set and better mechanisms to be put in place.
Yeah, I mean, I'm with you on that. I think the major structural problems that were on display for this particular event was those linkages between centralized and decentralized exchanges. I think the other thing is just basically, increased education. You're showing a liquidation chart here, which is this large spike on the far right, which is what I think was last Friday. Now you're seeing a large green bar, which is long liquidations, but you're also seeing a large spike down in the red bar, which is short liquidations. And a lot of that came out of Hyperliquid. Now, Hyperliquid didn't do anything untoward, as far as I can tell. Their liquidation engine acted the way it was programmatically designed, which is to basically auto deleverage positions during a major liquidity event. And what that meant, unfortunately, for those that had short positions who were going into this liquidation event, actually on the right side of the market, were liquidated first. At least that's my understanding. Now, I guess the point here, I think, for everyone to understand from my perspective is that when you're trading, you're not just trading against the market and other participants in sort of a zero-sum game. You also are trading against the venues themselves, and that includes the decentralized venues as well. So I think really what I hope that comes out of this is greater education of what the risks are when you're taking on leverage. I also believe that leverage is healthy. I believe that DeFi fulfills an extremely important role in the global financial system and is going to do wonderful things, which it already has, including banking the unbanked. But I do think that better education about the risks when you put it on position in these platforms is probably what's required.
Yeah, I agree.
So you obviously liked this video enough that you've got to the end. That's quite a big task. But listen, do me a favor, hit the like and subscribe button and also check out what video's next because I think you'll love it. But if you want even more, and when I'm talking more, I'm talking about member-generated ideas, incredible alpha, research, everything there to help you in your journey, just head to realvision.com/join for the best financial intelligence out there and the pure alpha that's within the platform.